Good morning, students. Welcome to the revisionary class on Advanced Financial Management, Forex, and International Financial Management. In the last session, we had discussed about the foreign exchange exposure, the basic concepts there, and we have also learned about how we will hedge our exposure in foreign currency. So we had already covered the money market hedge, and we had already covered forward and futures. So forward futures options are three of the derivative ways in which we can hedge our currency or hedge our foreign exchange exposure. So what was the difference between forward and futures was that forwards was over the counter, whereas futures is a exchange traded. So there is a clearing house in between, which means things will be standardized. There will be a standard size of the contract and a margin has to be given for entering into a contract. Whereas forward means you can have any kind of negotiation with the other party. So the risk in futures is less and the risk in forward is higher. We have one more way in which we can hedge our risk in case of foreign exchange exposure, and that is through option contract. So let us take one case scenario where we will exploit all the three ways, not futures, but money market, forward, and option, and see. Finally, we will come across which option or which of the following alternatives gives us the best results, and we will try to adopt that. So let us take this case where we have XYZ Limited is a US firm and this requires 300,000 pounds in 180 days and is evaluating different strategies to hedge against currency risk. So what does it need? It needs 300,000 pounds in 180 days. The available market data is as follows. Current spot rate is 1 pound is equal to $2. Whereas after 180 days, 1 pound will give you $1.96. Or you have to pay $1.96 to get 1 pound. There is no bid and ask, only one rate is prevailing. The interest rates are also mentioned. In UK, for 180 days, deposit rate is 4.5%, borrowing rate is 5%. In US, the deposit rate is 5% and borrowing rate is 5.5%. What is the option contract? Call option is available on pounds, which is expiring in 180 days. Exercise price is $1.97 and premium is $0.04. So remember that if call is exercised, to get these 300,000 pounds, it will be exercised when 1 pound is greater than $1.97. If it is less than 1.97, we will buy from the market. But if it is greater than 1.97, we will exercise the call. So if the market price of the pound exceeds $1.97, then the call is exercised. And together with premium 0.04, the pounds will cost us 2.01 per dollar per pound. Okay. So this will be the rate it will cost us if call is exercised. If call is not exercised, that is when the price of 1 pound in the market is less than $1.97. In that case, the cost of 1 pound will be the market price, the current market price of the dollar pound plus 0.04 premium. Now there is a different way in which we will calculate how the what is the cost if call is exercised or call is not exercised. So what will be the cost of 300,000 pounds in case of call options? We will see that. And why are we going for call option? Because it is available on pound and we need to buy the 300 pounds in 180 days. So it is a call option. Call options gives us the right to buy the currency, commodity, or any other product, underlying asset. XYZ Limited has forecasted the following probabilities for spot rate after 180 days. So what will be the scenario after 180 days? It's not fixed. They have been given in case of probabilities. So here you see the call will not be exercised, as we can get it in the market for 1.91. So why will we buy it for 1.797? Here also the call will not be exercised, because if it is available for 1.95, we will not exercise the call and take it at 1.97. 2.05, yes, the call will be exercised. So here it is going to cost us 1.91 plus 0.04. Here it is going to cost us $1.95 plus 0.04. And here it is going to cost us 1.97 plus 0.04 premium. So the cost here would be 1.95, 1.99 and 2.01. These have their respective probabilities as 0.25, 0.60 and 0.15. So there is absolutely, this is what will be the cost in case of call option. I hope this is clear to you, all of you. Okay. So we will have.
Madam, just write little bigger font.
Okay, sir. I will. So 1.95 into 0.25. This is 0.4875. 1.99 into 0.6. This is 1.194. And 2.01 into 0.15. This is 0.3015. So when you will add the 3, you will get 1.1940 plus 0.3015 and plus 0.4875. So 1.9830. So we have to choose from this information the correct answer for the following multiple questions. Now we have done the working for the call option. Current spot rate is this. The forward rate is 1.96. And we will also do the money market hedge where the US and UK rates for deposit and borrowings are also given. So first question is, the expected dollar amount needed to make the payment. Excuse me, just a minute. Give me a So the first question is the expected dollar amount needed if XYZ does not hedge. So if XYZ does not hedge, then whatever will be the prevailing interest rate, the rate of spot rate, we will have to follow that. But the spot rate that is there is also given under probabilities. So it is not the exact same rate that here we don't have one answer. The prevailing rate in the spot market, once again, is not one single price, but it is three different prices with probabilities 1.91, 1.95, and 2.05 with probabilities of 0.25, 0.60, and 0.15. So the expected prevalent price after 180 days is going to be 1.91 into 0.25, 0.4775, 1.95 into 0.6, which is 1.1700, and 2.05 into 0.15, 0.3075. So you will understand and appreciate that when we were doing the same thing for the call option, here we were taking 1.91 because the call is not exercised plus 0.04. 1.95 plus 0.04, but here we did not take 2.05, we take 1.97, the exercise price, and plus 0.04 premium. But the spot rate after 180 days, when we'll calculating, that is the expected spot rate that we will get. So it is 1.1700 plus 0.4775 and plus 0.3075. So the expected price would be 1.955. So this is still 3 decimal place. That means 1 pound will cost us $1.955. So if this is multiplied by required $300,000, our answer would be 586,500, right? So this is the expected dollar amount needed if XYZ does not hedge. So there is no forward contract, no money market hedge, no option contract, and it will cost us 1.955. Second question, if XYZ chooses the forward contract option, what is the expected dollar amount needed in 180 days? So the forward contract is very clearly given, 1 pound. Forward contract was $1.96. 180-day forward rate, 1 pound is equal to $1.96. So it is going to cost us 1.96 into 300,000. So what should be the answer?
$588,000.
Right. A would be the answer. Great. Third question. If we are using the money market hedge, how much will XYZ Limited need to repay after 180 days? So we have to see what is the rate in UK for deposit and borrowing, and in US for deposit and borrowing. So the 180 days rate 4.5 and 5%, 5% and 5.5%. Okay. So remember in the last session we had discussed about the money market hedge. What do we need to buy? we need to buy 300,000 pounds. So we should arrange that we receive exactly 300,000 pounds. Create an arrangement where you receive 300,000 pounds. So you're going to receive 300,000 pounds only when you have deposited 300,000 pounds somewhere. So you don't need to arrange exactly 300,000 pounds. You will deposit the present value of 300,000 pounds. Now, one important fact here is that the rate of interest is given for 180 days. Okay. If this was given per annum, we could have divided by 2. Or if we assume it to be per annum, then it is for 180 days we'll have to calculate. But if we assume it to be for exactly 180 days, then we will use 300,000 divided by 1.045. So you need to have deposited 287,081.3397, which I'll round off to 0.34, or you can also ignore 0.34 altogether here. What is the current export rate? 1 pound is equal to $2. So to get 287,081 pounds, you need to pay 287,081 into 2. Dollars needed today to make this deposit is 5,74,162. These will be borrowed in the US market at 5.5%. So 574,162, this will be repaid after 180 days together with interest. So you will end up paying 574,162 into 1.055. So 605,741 will be the answer. Have I taken this as for 180 days half, I would have got a different answer. Okay. So what would have been the answer then? 300,000 divided by 1.0225. Then I would have needed 398 pounds into 2, this many dollars, 586,797. And then they would have been repaid with interest at 5.5 divided by 2. So 586,797 into 1.0275. Okay. Now that answer would have been 602,933. 934, round off. Okay. But that answer is not there in the options. So you can have, if there is multiple choice questions, as we see in the ICAI also, where we have 605,741. So that is the answer. So you can see that it is not for 180 days interest is 4.5% and 5%. Okay. If both the answers are there, then that may pose a little problem for you. But then one of the answers is there. You can ensure that if you're not getting the right answer from this method, you can check and you can get the answer. Alternative that let the interest of 4.5% is for 180 days. Okay. As such also per annum is not written here. If per annum is written here, then there is absolutely no doubt that you have to assume this for the year and you have to calculate the interest applicable for 180 days. Next, if XYZ chooses the call option contract, we have already done the working. if it is a call option, it would have cost us 1.9830. So 1.91 call is not exercised plus premium. So 1.95 into 0.25. 1.95, then also the call is not exercised. Together with premium, it will cost us 1.99 with a probability of 0.60. But if it is 2.05, then we will exercise the call and we will buy the pounds at 1.97. Together with premium, it will be 2.01, and that has a probability of 15% or 0.15. So the expected value that it will cost us in call option is 1.9830. So 300,000 into 1.98. So it is 1.91 plus 0.04 multiplied by 0.25 plus 1.95 multiply plus 0.04 multiplied by 0.60. Plus 1.97 into 0.15. So when you will solve this, it comes out 1.9830. What is the answer now?
Ma'am, we are getting 594 900.
We are getting 594 900.
900.
Okay. So that would be the right answer, 594 900. Just check for the calculation if you don't get any answer here. $1.99 into 0.6. Okay, this I taken as 1.1940 plus 0.4875 and plus 2.01 into 0.15, 0.3015, 1.983 into 300,000. So that would be the answer, okay? 594 900, okay? So when you are doing the call options, always take the three alternatives separately. You cannot calculate the expected value as 1.955 of the expected market price and then decide that you will exercise the call because it is less than 1.97. So the most important part in call option is that you have to take all the three scenarios separately. Okay. Next is, what is the expected spot rate per pound after 180 days? So the expected spot rate we have already calculated. This is forward. The expected spot rate is 1.955. So which comes out to be 1.96. Maybe this answer is also, maybe because of some rounding off, this could be different. So let's say 1.98 if we take, ignore the 300,000 into 1.98. So you can always mark the closest answer in that scenario. Okay. Here also, if you had rounded off till 2 decimals or 0.49, 1.19 and 0.30. So you can get different answers depending upon how you have rounded off the answers. So you may get slightly different answers, but if the question says specifically that your rounding off is required till 4 decimals, 2 decimals, you have to stick to that. Okay. So this was the scenario for money market hedge. You had a liability, like you needed a pound, 300,000. So if you need 300,000 pounds, you need to create an asset that you should receive or deposit 300,000 pounds somewhere. Create a situation when you will receive from the deposits 300,000 pounds. So what you will do, you will lend or deposit the present value of 300,000 pounds. So you will need these many pounds, then convert it into dollars using the current exchange rate. So you will need these many dollars. These many dollars you will borrow today. And finally, you will repay this together with interest. So the dollar interest was 1.55 for the borrowing. 5.5%, so 1.055. So this will be your net dollar outflow, irrespective of what is the exchange rate for the pounds after 180 days. I have also taken the concept of futures. So I'll just explain once slightly. So in futures also, like you remember, we have done in the last session, that we create a situation that if you have an asset, so if you want to have, you have receivables, you have assets, okay? That means you are going to receive that money and you are fearing that the price may not go down. So if you have dollar receivables, for example, so the hedging strategy is to take a future contract. So you will sell dollar futures, right? But what if rupee futures are available? So you have to be careful here that if the receivable is in dollars, you will sell dollar futures. But if rupee futures are available, you will again take the opposite position. So either sell dollar futures are sold, or if rupee futures are available, you will buy. Okay. So whatever the standard size is, that will give you the number of contracts. Once again, you will round off those contracts to the nearest number, higher number or lower number, until specifically said. If you round it off to lower, you are remaining unhedged with some part of the currency. But if you round off to the next number, then there is a your exposure is fully covered, but you have some extra dollars or some extra rupees for which you may gain in future or not. Future will be available at a given price and there would be future price at the time of settlement. So my point here to explain this is, which we were doing in the last session. So if you have receivables, you will sell dollar futures. But if the dollar futures are not available, futures are available of the opposite currency, you will again reverse your position and you will buy rupee futures, right? And in the spot market, you will sell your receivables, whereas the future gain and loss together with interest cost, maybe opportunity cost or maybe the interest, that will be your net inflow or outflow. Right. So I hope the option part is clear. The important thing in options is that you must take care that if there are different prices in future going to be with probabilities, you will not first calculate the expected price after that period and then see whether the call options are exercisable or not. You will have to apply the call options at each individual price first and add to that the premium cost and then multiply it by the probabilities to get the expected outflow in case of options. Your next example here in Forex is where to make the investments. So this is one question. You have three options here. Your bank's London office has surplus funds to the extent of $500,000, and that is for a period of 3 months. And this is going to cost 4% per annum. 4% per annum and 3 months. It means 1% would be the interest cost or cost of funds. So 1% on 500,000 is 5,000. But you have this surplus which you propose to invest in either London, New York, or Frankfurt. And then you can obtain the best yield without any exchange risk to the bank. The following rates of interest are available at the three centers for investment of domestic funds there at a period of 3 months. So these are the rates which are prevailing in UK or London, New York, and Frankfurt. So the question is, where would you make the investments? Now here the market rates in London for dollars and euro as are under. London or New York, 1 month spot, 1 month, 2 months, 3 months. So 1 month and 2 months is not relevant for us. We are interested in spot and 3 months. Similarly, London on Frankfurt, spot, and then after 3 months. So this is dollar on pound, and this is euro on pound. So London on Frankfurt and New York on London. Now you have 500,000 USD to invest, which you can invest in London, US, or Frankfurt. If you invest in London, you have to convert it into pounds and then make the investment. If you have to invest in Frankfurt, you will have to convert it into euros and then make the investment. But your final answer should be in pounds. What is the net gain in pounds? That you have to see. Okay? Because your bank's London office has surplus funds. Now first let's invest in London, which will give us 5% per annum. Again follow that policy, 5 divided by 400 plus 1, that is 1.0125. So the London will give us this interest. New York will give us 8 divided by 400 plus 1, or we can say 2% for 3 months, so 1.02. And this will be 3 divided by 400 plus 1. So this will give us 1.0075. So if the investment is made in Frankfurt, multiply by 1.0075 to get it in euros. If it is made in New York, 1.02. And if it is made in London, 1.0125. But how much will be invested? If you are investing in US, it is 500,000 into 1.02. This will be the investment, and after 3 months, you get these many USD. If you make investment in pounds, then 500,000 US dollars have to be converted into pounds first. What is the rate of pound? Spot rate against dollar, the bid and the ask. So you're going to sell the dollars. Indirectly, you're going to buy the pounds. So when you buy, ask rate is applicable. So 1.5390. These are the number of pounds you will have for investment. You will invest 3,24,886 pounds or 0.2 9 pounds, and London is going to give you interest of 1.0125. Once again, slight difference can be there because of rounding off. So you round off till 2 decimals and then you can multiply. Or you can take it in exact currency, 324,886. I'm taking it till 2 decimals and into 1.0125. So you end up getting 328,947.37 pounds. And if you convert it into Frankfurt, now dollar against euro is not directly available, so you will use the cross currency rates. So we need euro by pound, dollar. And what do we have? Dollar by pound and euro by pound. So if I will inverse this rate, right? So you will have 1.8260 bid of euro by pound bid multiplied by 1 upon dollar by pound ask. So what will happen? Euro by pound into pound by euro dollar. So this will get cancelled and you will have euro by dollar. So 1.8260 multiplied by 1 upon dollar by pound ask divided by 1.5390. 1.8260 divided by 1.5390. So this is giving us 1.1869 rounded off till 4 decimal places. Okay. So $500 will give 500,000 into 1.1869 So this will become 5,93,450 euros to invest, and with interest of 1.0075. You end up getting 5,97,900 or 900.87. This is what you end up getting in all the three currencies after you have made the investment, after converting it into respective currencies. Now to compare, we will need the 3 months forward rates, and we will need to calculate everything in one currency. So we will stick to only pounds. Another important thing is in USA also it is going to cost us 4%. 4% means 1%. So 500,000 into 500 plus 5,000. Okay. That is to be repaid also. So the first question is, what will be the pound return if investment is made in USA? So all that was working. If investment is made in USA, you will end up getting 510,000 USD, right? 500,000 into 1.02. But you will also have to pay 1% cost for 3 months. So you have to, this is your cost. So ultimately you end up having only $5,000. Now $5,000, convert it into pounds. after 3 months. After 3 months, dollar by pound is 80 and 85, which means the prices are increasing. So it will be 1.5430, adding 80 to 5350, oblique 1.5475. These are the rates for dollar against pound after 3 months, 1.5430 and 1.5475. So when you want to convert, you have to sell the dollars or buy the pounds. And when you want to buy the pound, it is going to cost you the ask. So 5,000 divided by 1.5475. You can also remember we had dollar by pound, bid and ask. So you can convert it. How much will be the cost of, how much will each dollar give you? 1 upon ask, oblique 1 upon bid. So we are going to sell $5,000 and we are going to end up getting 5,000 divided by 1.5475. That means 3231.01 pounds. Is this clear? So this was about alternate investments. You can make investment in US, you can make investment in London, you can make investment in Frankfurt. What you have is $500,000. So if you make investment in US, you are investing $500,000, which will give you with interest $510,000 and minus cost $505,000. So you end up getting only $5,000 net, which when converted into pounds end up getting 3231 pounds as the returns. So return from investment in US dollar is 3231 pounds. Next, if we make the investment in London, so first convert the 500,000 pounds USD into pounds. So you need to sell the dollars or buy the pounds. When you want to buy the pounds, ask rate would be applicable. So once again, 500,000 divided by 1.5390, 324,886, and then that will give us a return of 5% per annum, which makes it 1.25 for 3 months. So you end up getting 328,947. This is what you get. Now you have to repay the dollars with interest 5,000. So let's convert to repay the dollars. What is the cost? You need to pay dollars. That means you need to buy the dollars. That means sell the pounds. So when you want to sell the pounds, the applicable rate would be bid, which means 1 upon this rate would be applicable. So you can convert it into pounds. But this is done after 3 months. So the rates are 1.5430 and 1.5475. So you want pounds. So if you want to buy pounds, ask rate is applicable, but you have dollars. So it is 3,26,332. So the pound return here will be less. Okay. Next, what will be the pound return if investment is made in Frankfurt? Okay. The third option, if you make the investment in Frankfurt. What is happening when you are making the investment in Frankfurt? First, you convert your dollars into euros. You get 593,450, and then you get an interest on this. So you end up getting 597,901. Is it clear, team? But if you look at the spot rate or the swap points for the London and Frankfurt rate, you will see that it is 145/140. So the rates are decreasing. So when after 3 months you are going to calculate the cross currency rates, when you convert the euros into dollars again or into pounds, you have to ensure that you have to add in this, but you have to subtract the rates here. Okay. So this is clear. Investment in US. This is investment in London, which will give you 328,947. And then when you repay the pounds, dollars, which you have to pay with interest, so that will give you how many pounds you have to pay, and the difference will give you the pound return. So it will come out to be less. What will be the pound return if investment is made in Frankfurt? So let's discuss this again. First, let's get the rates from here. Dollar by pound, 1.53. I'll take another slide to do this calculation. Let me erase this. So we have calculated for the USA. We have calculated the return on the pounds. So it's 328,947. Okay. All right. So London on New York, current rate is, we need euro by pound, which is given, and we have dollar by pound, which is given. From this, we need euro by dollar or dollar by euro. So this will be equal to first, let's calculate the 3 months forward rate. 1.8260 minus 145. One 1.8115 oblique 1.8290 minus 0.0140 and 1.815. So dollar by pound is 1.5350 oblique 1.5390 and euro by pound is 1.8260 oblique 1.8290. Now you need to first convert your dollars into euros. So euro by dollar is required. For this, if you have euro by pound multiplied by pound by dollar, you will get euro by dollar. So we will have, this is our euro by pound. This is dollar by pound. So it is 1.8260 divide by 1.5390 is the bid and 1.8290 divide by 1.5350 is the ask. So euro by dollar current is 1.8260 multiplied by 1.5390. 1.2037 oblique 1.8290 divided by 1.5350. Not 1.12. 1.1865. It's 48, so it's 5. And 1.8290 divided by 1.5350. So 1.1915. But you need to sell the dollars. Therefore, you need to use the bid rate. So 500,000 into 1.1865. It becomes 593,250, sir. 048 it was. So 5,93,250 and into 1.0075. So this becomes 5,97,699. So after 3 months, these are the euros you have. Now convert these euros back to pounds. What is the euro to pound rate? Euro to pound rate is directly given here. After 3 months, it is this. So you will sell the euros, indirectly you'll buy the pound. And the ask rate for pound is 1.5475. So you will get 386,235 pounds. Now you need to sell the $505,000 also. Now dollar is clearly straight away available. This is for dollar, not euro. The rate is after 6 months is this 1.1855 and 1.815. So you'll apply 1.815. €597,699 you have. And after 3 months, the rates are 1.8115. These are the rates for euro to pound. And you need to buy the pounds. So ask would be applicable 1.815. $597,699 divided by 1.815. So you end up having 3,29,310 pounds after 3 months. And the dollars were 5,05,000. That can be again converted into pounds. How much pounds you will have to pay? So you are selling the dollars, buying pound. Again, pound ask is applicable 1.5475. So this will be divided by 1.5475. When direct rate is available, we will use that 326,332.79. Okay. So this is your return in Frankfurt. This is in euro if you invest in euro. This is your return if you make investment in USD. And this is if you make an investment in London. Okay. So which center will give you the investment? What will be the net gain to the nearest pound? So you will compare the 3 investments. Which one is giving you the best result in pound? So 3231 is in US. If you make the investment in US, so that will come out to be the highest only. And therefore, the investment should be made in New York. All will not be the same. Okay. Any doubt or any question here? I'll quickly repeat what you are supposed to be doing. Okay. You have 3 options to make investment. You have 500,000 pounds, which are dollars, which is going to cost you 4%. So ultimately you have to pay 500,000 plus 5,000, 5,05,000. Now, if you're making the investment in USA, you will end up getting 5,000. You are earning 2%, but paying 1%. So you end up getting 1%. And you end up getting only 5,000 USD net, which when you convert it into pounds after 3 months at the rate of 1.5475. So you end up having 3231 pounds. Now, when you are making investment in London or you are making investment in Frankfurt, this 5,05,000 pounds dollars would be paid. So once again, when you divide it by 1.5475, 326,332 is what you end up paying. So this will be applicable 326,332 whether you are making investment in London or whether you are making investment in Frankfurt. So this is what you have to pay. Why 1.5475? Because after 3 months, dollar by pound is this much. So you're going to sell the dollars, which means bid is applicable, which is 1 upon ask. So this will be the rate for pound to dollars. So $1 will give you 1.5475. 1 upon, you can also do 1 upon 1.5475 or you can directly divide it. So your outflow for dollars is going to be 5,05,000. So 5,05,000 when divided by 1.5475, it is 326,332. Now, what is the returns that you are going to get? So if you invest in London, today you will be able to get how many pounds? First, you have to check that. So you have $500,000, which you will sell. That means bid is applicable, which is 1 upon ask. So divide by 1.5390. These are the dollars, pounds you are going to have 324,886. Pounds will be invested for 5%. So into 1.0125, your net return would be 328,947. And from 328,947, when you will subtract 326,332 together with interest, you end up getting 2,615 pounds. So it is less than 3,231. Therefore, the investment in London is not going to help. Similarly, if you make investment in Frankfurt, so 5,93,250 with 1.0075. So it's 597,908. This is what you're going to get. Now then, euros are this Frankfurt, euros will be converted into pounds again. Now euro pound is again directly available, you can see. So when you will convert it, these are the two rates. Either you can take it as 1 upon also. You might get a different answer because of rounding off. Okay, you have to be very careful. So if I divide by 1.815, it's 0.5509 pounds, and multiplied by 597,699, this comes out to be 329,310. Okay, so 329,310 minus 326,332 or 333, this gives you 2,977. So we can see that the best result is when you're making the investment in US dollars. Okay, so New York will give you the best answer. So this is another type of question which you get in Forex when you have to make an investment in different currencies. Your next question is on early delivery. So the last that we'll discuss in Forex is what happens when there is early delivery, cancellation, or late delivery when it is extended. So when you cancel the contract, when you expedite the contract, make it early, or when you lag it, or when you delay the contract. So when you extend the contract. So on 1st October 2024, Mr. G is an exporter. He enters into a forward contract with a bank to sell US dollar 100,000. So firstly, you have to be very careful who is their exporter. So if he is an Indian exporter, he is going to receive USD. And therefore, he will sell the USD. So you have to see whether the exporter is entering into the bank to sell or the bank is selling. So language is also clear that exporter is selling, which means the bank is going to buy. The exporter will sell and the bank is going to buy the US dollar for $100,000 and the rate committed is 85.40. So remember that whenever there is an early delivery or a late delivery, the contract is honored at this price only. However, because of this, there can be a swap cost. This swap can be a loss or gain, which will pass on to the customer if it is a loss. And there can be some outlay of funds from the bank's side. Therefore, interest may be charged or will be charged on this. So there are swap charges if there is a loss, and there can be interest. However, at the request of the importer, Mr. G received the amount on 30th November. So on 1st October, he is entering to sell it on 31st December. So October, November, December. Technically, it was a 3 months contract. Whereas on 30th November, that means 1 month prior or 31 days before, there is an early delivery. So what happens is, like, I am an exporter, I'm going to receive the dollars on 31st December, which I sold to the bank at 85.4. Now on 31st December, if I receive my money, I'm going to get 85.40 lakhs. However, if I receive it 1 month before, on 30th November, I don't have a forward contract with the bank on 30th November. So what will happen is I will have to go to the bank and request the bank to take a early delivery. So Mr. G requested the bank take a delivery of the remittance on 30th November before the due date. Now on 30th November, the interbank rates were these. INR against USD was 85.22 oblique 85.27, and there was 1 month premium. So on 30th November, the forward rates for 31st December will be, swap points are increasing. So it is 85.32 oblique 85.42. So if the bank agrees to take early delivery, what will be the net inflow to Mr. G? So if bank agrees, net inflow to Mr. G would be at 85.40. But if there are swap charges, swap loss or interest loss, that will be deducted. Second, if Mr. G can deploy these funds in USD and earn a return of 3% per annum, then advise which option is better, deliver to the bank or investment in USD. So this Mr. G has an option that whatever the dollars he receive on 30th November, he can keep them invested in USD for 3% per annum. Now, if you have 100,000, so they will give you 3% return, but only for 31 days. So this is the interest you will end up getting. 100,000 into 3%, which is 3,000 into 31 days, divide by 365. So he ends up getting 254.79. We can round it to the next decimal, $255 as interest. So what he can do is, this 100,000 he will honor with the bank on 31st December at 85.40, and the interest component 255, he can sell it in the open market and he can get 85.22. So he will not make the investment. He will not ask the bank to take early delivery. He will rather invest these dollars and he will sell them in the open market, the extra interest, and cover the 100,000 with the forward price. Now assume the prevailing prime lending rate is 18% per annum and the deposit rate is 12% per annum. Round off all calculations up to 2 decimals. So this one is very clearly saying round off all calculations up to 2 decimals. So I'll have to stick to 254.79 USD. Okay, that will be for rates also and for the currency also. So I'll take 254.79 only. Okay. So what are the questions? First question is, what will be the swap difference? So what will happen is, when Mr. G sells these dollars 100,000 on 30th November, so bank will sell these in the open market, and on 30th November the open market rate is 85.22. And bank will again buy for 31st December on forward rate, because now Mr. G is not going to sell it to bank. So bank will need to buy it for 85.42. Bank will buy, which means ask. So look at it. Mr. G will make the dollar payment to dollars to bank. What will the bank do with that? Bank will sell it in the open market at the bid rate. But to cover its position on 31st December, because now on 31st December, G will not be giving him the dollars. So bank will buy it in the open market at 85.42. So this is the swap difference, 85.42 minus 85.22. So the difference is a loss which customer has to pay 0.20 on $100,000. This is per dollar. So 100,000 into 0.20. The swap loss would be 20,000 rupee. Okay. So what will be the swap difference? 20,000 rupee. A is in dollars. So C is the right answer. What will be the interest cost to Mr. G if he takes early delivery? So what will happen is, as Mr. G will take the delivery on 30th November, bank will pay him the rate which is committed to him, which is 85.40. However, the bank has bank sells it in the open market at 85.22. So bank will pay Mr. G 85.40 and bank will sell in the market at 85.22. So this will be a loss to the bank and outflow of funds from bank's pocket at the rate of 0.18. Total outflow unexpectedly by the bank, 100,000 into 0.18, which is 18,000. So bank is going to charge interest on 18,000. Now, what is the rate at which the bank is charging interest? 18% for lending and deposit is 12%. So into 18% for 31 days. So 18,000 into 18 into 31 divided by. So the interest comes out to be 275.17. I would have left it at 275, but as the question is very clearly demanding that I should round off to 2 decimals, so 275.18 rupees. So what will be the interest cost to Mr. G? 275.18. What will be the swap loss to Mr. G? 20,000. So what is the net inflow to Mr. G? 1 lakh into 85.4, it's 85 lakh 40,000 minus 20,000 and minus 275.18. So he will end up getting 85 lakhs 19,724.82. If Mr. G can deploy these funds in the USD and earn a 3% per annum, what will be his inflow on 31st December? So like we said, the 100,000 he will sell in the forward market with the bank, which he's already agreed with, 85.40. So for this, he will get 85 lakh 40,000 rupees. And the interest which he has earned, $254.79. Interest, $254.79 will be sold in the open market at 85.22. So it is 21713 additional. So he ends up getting 85,61,700. .20. Let's see this. Okay, this rate will be applicable, sorry. This is on 30th November, but he will be selling on 31st December, so 85.32. .1738. 0.68. So this will be his inflow if he keeps the investment in US invested for 3% per annum, and then on 31st December sells the $100,000 at the forward price plus the interest which he received at the stock price or the spot price and 31st December at 85.32. What will be the net inflow to Mr. G if he takes early delivery and invests for 1 month? So if he takes early delivery, he ends up getting net 85,19,724.82. 85 lakhs 19,724.82. So this is what he gets on 30th November. This he can invest in India at lending rate, which is 12% per annum. For 31 days. So 85,19,724.82 into 12% for 31 days is 86,831.17. So he ends up getting 86,06,555.99. Okay. So if he invests, he takes early delivery and invests in India at 12%, he ends up getting 86,06,555. But if he makes investment in US and then converts it into rupees, he ends up getting 85,61,738. So if he takes early delivery and invests in India, he gets better returns. Okay. Right? One question which I'll explain to you. XP Pharma Limited has acquired an export orders as well as there is an import from a European company. The company has also planned to import bulk drugs worth 5 million from a company in UK. So there are export orders also, which is $10 million, and there is a import also, which is 5 million. Exports is in 3 months and the imports is in 6 months. So there is an export. So there is dollars European company. Euros receivable, or I would say receivable, which is rupee 10 million. And this is after 6 months. After 6 months, you are going to receive 10 million. And after 3 months, you are going to pay 5 million. Imports payable, rupees 5 million. But this is after 3 months. This is 3 months and this is 6 months, sorry. So receivables are after 3 months and payables are after 6 months. The question is, in which currency will you invoice? Will you invoice it in dollars, euro, or pound? So you will see that what is the spot rate. Now, if you have 10 million rupees to be received, and if you will invoice it in dollars, the current prevailing spot rate is 87.10 and 87.20. So if you will invoice it in dollars, how much you will get? And then if the annualized premium is 7%, we will assume the annualized premium to be usable for the purpose of forward rates, assuming interest rate parity will hold good. So what will be the INR inflow from exports if the invoice is raised in dollars? Okay, there is an MCQ question. If you raise it in dollars, what will be the inflow? So you have 10 million. Divide by 87.10. So you will get $1,14,810. Now annualized premium is 7%. So the new exchange rate would be 87.10 into once again 7 divided by 400 plus 1, because it is 3 months. 7 divided by 400 plus 1. So it is 1.0175. So the new exchange rate is going to be 87.10 into 1.0175. 88.62425. Round off 88.6243. So we will do calculations. What is the current exchange rate? 87.10. What it will become after 6 months, after 3 months. So at that rate, if you are going to convert your dollar raised invoice, that will give you these many rupees. Okay. Similarly, if you had it in euros, so 10 million divided by 101.15 is what you would have got today. But if there is the future price would be 101.15 into 1.015. Okay. Similarly, for the pounds. So you will calculate the prices for all the 3 currencies and what will be the exchange rate after 3 months. Find it what is your exports receivable for rupee 10 million. So you're going to sell the rupee. Indirectly, you are going to buy the foreign currency. And when you have raised it in dollars, so you will sell dollars. So your bid rate will be applicable. So when you raise it in euro, bid rate for euro will be applicable. If you've raised it in pound, these are the rupees you're going to get against the pounds. So use the bid rates in all the three scenarios. And after using the bid rates, you will apply the premium as forward rate interest to find out the forward rates and convert it into your dollars converted into rupees, euros converted into rupees, and pounds converted into rupees. So in three steps, you will do the question. First, 10 million will be converted into dollars to find what is the invoice value at today's spot rate. Okay. Remember, bid rate would be applicable, and then apply the interest rate using the interest rate parity theorem to find out the forward rates, and then convert this dollar invoice with this rate into rupees again. Similarly, if you raise it in pounds, similarly you will do the question. And if you raise it in euros, exactly same fashion, you're going to calculate. So what will be the answers? 10 million divided by 87.10 into 87.10 into 1.0175. 10 million divided by 101.15, and then that will be the euro invoice value. Then multiply it back into 101.15 into 1.015. So in this way, you will be able to calculate what is the export receivable. And wherever you get the maximum, you will raise your invoice in that currency. Similarly, for imports also, you have 3 months and you have 6 months for the imports and 5 million. So for that, you will use the ask rate and then convert it into current currency. And then you will ultimately find out once again using these rates, what will be the forward rate, and find out where the payables are least. So where the receivables are maximum and payables are least, that would be your answer. Okay. So team, these will be the questions. So what will be the INR outflow for imports if the invoice is raised in pounds, and so on. Now, because I hope this is clear, we have covered all the topics in Forex, all the basic concepts, and the money market hedge, forward, futures, options as the way of hedging currency, early delivery, alternative investments, and in which currency you should be able to raise the invoice if there is exports, or in which currency you would prefer to receive the invoice if there is imports. Let's now focus on our second chapter in financial management, which is international financial management. Okay. So I'm going to give you a 10 minutes break here. After that, we'll start with this chapter. Okay? Okay. Here we are more interested in seeing that when you have a subsidiary or investment in any foreign country, or when the foreign country has an investment in your country, how to calculate and how to find out that the inflows from that foreign country, should we accept that project or not? So we compare the inflows, outflows. We have to look at the exchange rates. We have to look at the inflation in the countries, and we have to look at the currency exchange rate. So here we have one question. The treasury desk of a global bank, which is incorporated in UK, wants to invest in Great British Pound 200 million on 1st January 2019 for a period of 6 months and has the following options. So it's the global bank which is incorporated in UK. The amount that you have for investment is 200 million pounds, which is available on 1st January. And this is for a period of 6 months. So what you have is 200 million pounds to be invested for 6 months. Now, when you say that the treasury desk is looking at this option, you have to look at that the treasury will make the best decision as far as the returns are concerned. So the purpose of treasury is to give maximum returns and remain safe. The investment is to be made for 6 months. First option is there is an equity trading desk in Japan. So it is thinking about investing the entire 200 million in high dividend yielding Japanese securities, and then you will get a dividend income also of 1182 million. So this is the return you're getting, 1182. The dividends are declared and paid on 29th June. So you see, from 1st January till 30th June, we have 6 months to invest. So when dividends are declared on 29th June, you will get these dividends, and post dividend, the securities are expected to quote at 2% discount. So once the dividends are declared, the price of the securities will fall and they would be decreasing by 2%. The desk also plans to earn Japanese yen 10 million on a stock borrow lending activity because of this investment. So another 10 million return because of the stock borrowing and lending activity. The securities are to be sold on 29th June with a T+1 settlement. So that means on 30th June, you will get your money back. And this amount is then remitted back to the treasury in London. So what is the process here? First, you have pounds. This you will convert into Japanese yen. After 6 months, you will get plus dividends, plus return from stock lending and borrowing of the securities, and minus discount on the value of securities. So you end up getting this much money on 29th June. So plus with T+1 settlement, on 30th June, you will end up having these many Japanese yen. These are again required to be converted into pounds. Once again, here we don't have the bid and ask. We just have on 1st January and on 30th June. So this will be converted first using the rate of 148. 1 pound is equal to 148.0002 Japanese yen. There are 4 decimals, so pip is 0.0001. And on 30th June, 150.0000. This is the first alternative. The second alternative is a fixed income desk of US. Second alternative is to invest in US. This will be again invested for 6 months in G6. G6 is the government securities or the treasury securities, and they provide a return of 5% per annum. The exchange rates are as follows: 1.28 and 1.30331. So 1 pound is equal to $1.28 and 1 pound is equal to 1.30331. As a treasurer, advise the bank on the best investment option. What would be your decision from the risk perspective? You may ignore taxation but calculate the figures in millions and round them off up to 4 decimal points. All right, let's first make investment in Japan. £200 million at the rate of 148.0002. So the investment is on 1st January 200 into 148.0002. So you will end up investing 29,600.04 million JPYs. All the figures are in million here. Dividend that you are going to receive is 1182. This is also 1182 million. And another return from borrowing and lending of securities is 10 million. Value of investment sold on 29th June at 2% discount, 29,600.04 into 0.98. So the value of investments is 29,008.0392. Total amount in JPY on 30th June. This plus 1182 plus 10 is 30,200.0392 million. Million is written here. Convert it into pounds at exchange rate of 1.150.0000. So this divide by 150 is equivalent to 201.3336. It's 59, so I rounded off 3336 pounds. Initial investment was 200. So net gain is 1.3336 pounds. This many million pounds. 1.3336 pounds. Investment in US. Convert the pound into USD at 1.28. 200 into 1.28. So it is 256 US dollars. Interest at the rate of 5% per annum. So for 6 months, I'll apply the interest at 2.5%. $12.40. Total value of investment in dollars, $268.40 million. Convert it into pounds. At the rate of exchange rate is 1.30331. $256 into 2.5%. 6.4, sorry. And 256 plus 6.4 is 262.40. This, when converted into pounds, divide by 1.30331. So you end up having 201.3335 rounded off till 4 decimals. So net gain is 1.3335 million pounds. Okay. So where do you have gain more? Here it was in JPY 1.3336 million pounds. And in US 1.3335 million pounds. So where do we have more net gain? The more net gain is definitely in Japanese investment. However, the difference is very small. And if you look at the decision from the risk perspective, G6 means government securities. Equity means Japanese trading desk, equity in Japan. So equity is always higher at risk. The risk is higher. And this is government securities or GSEC. Risk is low. So as a layman, if even we compare the risk and return, so it is a individual matter for each person how much risk you want to take. However, this is a treasury, so they have to act in a responsible and rational manner. So comparing the excessive return in Japanese yen, it is not taking the high risk. So if you look at from the risk perspective, it is more advisable to invest in US securities, G-SECs only, and not in the Japanese currency or Japanese equity market, right? Now, if Just think about it. If this question is not demanding 4 decimals, you will end up getting 1.33 both the places. So the difference is lying exactly in the 4th decimal. So it's very important that you stick to the question commands or whatever has been asked. So the demand of the question is 4 decimals. That's why you could make a difference. If you had taken this question into 2 decimals, you would not have got the right answer. Correct? Let us discuss one more type of question that is generally there in international financial management. Mr. Raghu Limited is interested in expanding its operation and planning to install manufacturing plant at US. The total amount it requires in US is 8.82 million USD, net of issue expenses or flotation costs. So if there is some flotation cost, let's say 100 is the price, and if there is a 5% flotation cost, then if I want, my requirement is 5,000, then this 5,000 should be 95% of the investment. 95% of issue is what I have with me. So that should be equal to 5,000. So similarly, here also you want 8.82 million USD. But whatever you will issue out of that, there will be some flotation cost, which is 2%. So this 8.82 should be 98% of the issue. So your issue size should be 8.82 divided by 98% or 0.98, which means your issue size has to be 9 million USD. Additional information is also given. You are going to issue the project through GDRs. The market price of the GDR is 360, whereas the face value is 100. Each GDR will represent 2 underlying shares. So 2 into 360 is the price of each GDR, which is 720. But you are going to price it at 10% discount. So 720 minus 10%, you will get 648 rupees from each GDR. The expected exchange rate is INR USD 72. So 1 US dollar is equivalent to 72 rupees. Dividend is also expected to be paid at the rate of 20% and growth rate is 12%. Now 100 rupees the face value. The 20% dividend will always be applied on the face value. So the dividend is going to be 20. Further, it is the expected dividend. So we will be using here our model of cost of equity is equal to D1 upon P0 plus growth. So this is our expected dividend. So expected dividend is D1. If this was dividend last paid or dividend just paid 20%, then we would have got D0. D0 would then have been 20 and we would have added D0 into 1 plus growth to find out D1. So if D0 is 20, then this. But here D1 is given as 20. This will help us find the cost of the GDRs. So you as a financial consultant are required to compute the number of GDRs to be issued and what is the cost of GDR. So how many GDRs will you issue? Now 9 million USD is what you require. 9 million converted into Indian rupee, 9 into 72. 9 million into 72. So you require 648 million rupees. And 1 GDR is for 648. So 648 when divided by exactly 648, you will have to issue 1 million GDRs. Amount to be raised? $9 million USD converted into rupee. $9 million into 72 is 648 million rupees. 1 GDR, underlying price of 1 GDR is 648 rupees. So number of GDRs to be issued would be 648 divided by 648, 1 million. So number of GDRs, 1 million. What is the cost of the GDR? What is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? So we are first going to compare the cost of GDR. So there are two shares underlying one GDR. So dividend will be 20 per share. 20 into 2 will be 40 is the dividend for 1 GDR. So D1 is equal to 40. Price, net proceeds that you issue is 360 is the face value and 10% is the discount, or 720 minus 10%, 648, and still 2% is lost in issuing cost. So 648 into 0.9298, sorry. The net proceeds you get from each GDR is 635.04. So the cost of GDR using the same formula, K is equal to D1 upon P0 plus growth, where K is the cost of equity, D1 is the expected dividend, P is the price or net proceeds from the share or GDR plus growth. So instead of P0, you can write here net proceeds. So this becomes 40 divided by 635.04 plus growth of 0.12. 40 divided by 635.04 is 0.0629 or 63 plus 0.12. So it's going to cost us 18.3%. So the cost of equity is, or cost of issuing the GDR is 18.3%. Now, what is the question? We have found how many GDRs? 1 million. What is the cost of GDR? 18.3%. What is the suggestion if the company can receive an offer from US bank which is willing to provide equivalent loan for 12%? So obviously 12% is less than 18.3%. It will be cheaper to raise the money through loan. However, you have to look at your existing leverage, how much you are already exposed. So there has to be a reasonable debt equity ratio. You have to take that into consideration. As such, if you look at the cost, definitely 12% is cheaper as compared to the GDRs. How much money the company can save by choosing the option as recommended by you. So when you will go for loan, you will take only 8.82 million. and the cost will be 12% of 8.82 million. Here it is costing you 18.3%. So there will be a saving of 6.3% on 8.82 million. Right? So this is how you will attempt this question. However, in the previous exam, we have this question of similar type. Therefore, less likely, I would say, as my opinion, personal opinion, but still you must know how to deal with this type of questions. Next, there is a concept that is required to be understood here. ABC Limited is considering a project in US. So in international financial management, you have to evaluate the project. There are two approaches in which you can evaluate the project. Either you can evaluate the project in home currency, or you may also evaluate the project in foreign currency. So how are we going to, what are the differences and how we do it? So this one is a basic concept on how to find out the risk premium first and then apply to the rates which are applicable in the foreign currency if we are going to evaluate using the foreign currency approach. So ABC Limited is considering a project in US which will involve an initial investment of US dollar 11 million, and the project will have 5 years of life. Current spot rate is rupee 48 per dollar. Risk-free rate in US is 8% and the same in India is 12%. The cash inflow from the project is as per the foreign currency. Calculate the NPV of the project using foreign currency approach. Required rate of return is 14%. So we have two approaches. One is the home currency approach, and the second is the foreign currency approach. So if you are going by the foreign currency approach, the inflows are given to you. All you will be doing is discounting them at a different rate, not 14% as in India, at a rate of risk-free of foreign currency plus risk premium. Now, risk-free rate can be different, but the risk premium will be assumed to be same for the project. If it is to be calculated in home currency, first convert the inflows outflows into home currency and then apply the discount rate applicable for the home currency. Which is risk-free rate of the home currency plus risk premium. Now this question is saying do it from the foreign currency approach, firstly. Secondly, the required rate of return on this project is 14%. So ABC is considering a project in US, whereas they want 14%. So the home currency requirement is 14%. And what is the risk-free return in India? It is 12%. So 1.12 multiplied by 1 plus risk premium should give you 14%, or rather say 1.14. So this will help us find out the risk premium. 1 plus risk-free in India, 1 plus risk premium is equal to 1 plus discount rate applicable for India. So it becomes 1.12 plus 1 plus risk premium, we don't know, RP I'm writing for risk premium, is equivalent to 1.14. This gives us 1 plus risk premium as 1.14 upon 1.12. So the risk premium is 0.01785, which is equivalent to 1.785. So if I add the risk-free rate 8% in US. So applicable discount rate for foreign currency 1.08, 1.0, 1785. So this is equal to 1.099278. So you can say 9.93% or 9.928%. After this, it becomes simple. You will discount all these cash flows using the rate as 1.09928. This will be divided by 1.09928 square after second year. This will be divided by 1.09928 cube, 1.09928 raised to the power 4, and 1.09928 raised to the power 5. So you will get what is the cash inflows for all the 5-year present value of cash inflows. You will sum up all the cash inflows and compare it with the initial outflow of 1 crore 10 lakhs or 111 million US dollars. If inflow is more, the project is acceptable, but if inflow is less, the project is not acceptable. Calculate the NPV. Present value of inflow minus present value of outflow. So if you get something positive, the project is worth accepting. If you do not get anything positive, if it is negative, the project is not worth accepting. Or we can say it is not meeting our requirement of 14% per annum return. Negative inflow means the project will give you less than 14%. Positive inflow means the project is giving you at least 14%, something more than 14%. At exactly 0, that means it's giving you exactly 14%. So this is how you are going to calculate the risk premium using the domestic currency discount rate and apply that risk premium to the foreign currency to find out what is the rate at which the discounting must be done to evaluate the project in foreign currency itself. We'll take up one more question here. Basis same, but here you will do it in both the currencies. So we have understood how it is done in foreign currency. Let's now look how it is done in home currency approach. TK Limited is considering an investment proposal in Sri Lanka, which involves an initial investment of Sri Lankan rupee 25 billion. So what is the investment? Investment is in Sri Lanka. How much does it require? 25 billion. Current spot rate is INR on Sri Lankan rupee is 0.37. So 1 Sri Lankan rupee will give you 0.37 INR. The risk-free rate in India is 6%. Home currency 6%. And in Sri Lanka it is 5.2%. The project will generate a cash flow of Sri Lankan 5 billion in the first year. What will be the cash flow? So outflow is year 0, 25 billion, but it is going to give you 5 billion in the first year. They will increase by 1 billion each year for the next 4 years. So 5, 6, 7, 8, 9. And no salvage value from the project. The required rate of the project is 8%. You require to find out the investment worth for the project by home currency and foreign currency approach. So you see, in India, the interest rate is 6%. And the required return is 8%. So this will again give us the risk premium. 1.06 multiplied by 1 plus risk premium should give you 1.08. When we'll do it in home currency, we will use the discount rate of 8%. So 1 plus risk premium is equal to 1.08 divided by 1.06. So this gives 1.0188 or 1.88%. This when applied to Sri Lankan risk-free rate, $1.052 because the risk-free rate in Sri Lanka is 5.2%. So we are trying to calculate this. 1.0188 1.071776. We can keep it as 1.0718. So 7.18% would be the discount rate applicable for calculating the value of project in Sri Lankan currency or the foreign currency. Apart from this, we will use the concept of Forex, interest rate parity or covered interest parity. So the INR on Sri Lankan rupee, which is 0.37 today, after 1 year, it should be 0.37 multiplied by 1.06 divided by 1.052. So this will become 0.3728. After 2 years, 0.3728 into 1.06 upon 1.052. You will have to round off your calculations till 4 decimals and you will mention it again and again. So you cannot continue to use your calculators in same figures. You will have to type them again because you are going to round off till 4 decimals. 0.3756 third year. So you'll create a table for calculation of forward rates. For 5 years using interest rate parity. $0.3756 multiplied by 1.06 upon 1.052. So this is 0.3756 into 1.06 divided by 1.052. 0.3785. 0.3785 multiplied by 1.06 upon 1.052. $0.3813 for the 4th year, and last 5th year 0.3813 multiplied by 1.06 divided by 1.052. So this is again 0.3842. So you will use these 5 rates to convert the inflows when you are doing it in home currency. So foreign currency approach and home currency. So home currency, firstly, the 0 year 25 million will become 25 divided by 0.37. That is, 25 into 37. 9.25 million rupee. Rupee in million. And first year, first 5 million will be converted using 0.3728. So it is 1.864. $6 million will be converted into 6 into 0.3756. 2.2536. Third, 0.3785. 7 into 0.3785. This will give you 2.6495. Fourth year, 8 million. 8 into 0.3813. 3.0504. And last 5th year, 9 million, and 9 into 0.3842. 3.4578. These will be discounted at 7.18%, and these will be discounted at 8%. So you can quickly calculate the PVIFA factors. PVIF factors 1 divided by 1.0718. For first year it is 1. For second year it is 0.9330. $0.8705. 0.8122, 0.7578, and 0.7070. So all these present values will give you the net NPV. So this is the NPV in foreign currency, final NPV in Sri Lankan rupee. Here you will discount it with factors of 8%. So 1 divided by 1.08, it's 1, and then 0.9259, so on. And then you will compare where do you have, which says what is the, whether the project should be accepted or not. So when you will multiply the present value, you end up getting 2.353, 3.0504 into 0.7350, 2.2420, 2.6495 into 0.7938, 2.1032, 1.9320. So it is quite possible that maybe in the foreign currency what appears good, maybe you turn it down when you convert it into home currency. So the present value comes out to be 10.35 and the outflow is 9.25. So net positive 1.1060 billion rupee. So as for the home currency, the project is worth accepting. Let us look at the Sri Lankan currency. 4.665, 5.223, 5.6854, 6.0624, and 9 into 0.7070 gives you 6.363. So if you add all the inflows, present value of all the inflows, this gives you 27.9988 minus 25. So 2.9988 Sri Lankan rupee in billions. So both are giving the positive outcome. project is good. But if you convert 2.9988 into Indian rupee today, that gives 1.1095. So it's giving 1.1095 higher as compared to 1.1060. Right? So this is how you will approach the questions on international financial management. Team, I'll utilize the remaining time first to take up the MCQs that I was dealing with you, and I had left the answers incomplete for the reason I was in constraint of time. So we'll complete the final calculations on this. So London office 5,000. And there is one important point that I wanted to bring to your notice here. The rate that was applicable was 1.815, which we were using when we were converting into Frankfurt, right? Now this gives you 597,699 divided by 1.815, 329,310. And the dollar outflow was this 505,000, 1.5475. So dollar is to be paid and it is to be bought. So dollar ask would be applicable. So it will be 1.5430, sorry. Right? Now, what I wanted to focus on here is 505,000 divided by 1.5430. Yeah. So it is 32. 327284.51. Now 327284 minus 329310. So this gives you 2025 or something around this figure, right? Now, one important thing is that if you use 597,699 divided by 1.815, you get this answer 2025. Whereas if I have used the rate 1 upon 1.815, okay, so 1 divided by 1.815, this gives me 0.55096 and round off 0.5510. So if I use 597,699 into 0.5510, I get 329,332. I'm getting a different answer. And then if this is subtracted from the original price, you get 2048 or approximately this is the answer. Okay. So it is possible that when you are doing everything right, you may still not find the answer. The reason is when 597,699 is divided by 1.815 and it is rounded off, you're getting 329,310. Whereas if I multiply 597,699 into 1 upon bid and then I get 1 upon ask, which is the bid I need, I get 0.5510 rounded off till 4 decimals. So I'm getting a different answer. Okay. So be careful. It may be possible in the exam. So you need to be careful here. Okay. So 327,284 and similarly when 327,284 will be subtracted from 328,947, this answer you will also get 1.5430. 327,284. So 328,947 minus 327,284. This gives you 1662. So when we were comparing, in US it is giving 3231, in London it is giving 1662, and in Frankfurt it is giving 2047. So therefore it's best to invest in New York. Okay. Finally, that is all that we are discussing today here. If there is any question, you may post it in the BOS portal. That's all from my side. Anything that you need, let me know. Besides this, there is this summary. You can take note this. This will help you to understand the questions and to approach the Forex better. What does it say? The exposure type, if you have imports payable, you will have foreign currency payable. If you are importing, you have to pay the foreign currency. So you can buy the foreign currency forward. You can use money market hedge, in which you will borrow in the home currency and invest in the foreign currency. What does this do? It locks future payment. If you are an exporter, you will have an asset, you will have a receivable. So you will have foreign currency receivable. You can sell the foreign currency forward, and in money market, you can do the opposite, borrow in foreign currency and invest in home currency. This also will lock your future inflow. In options, if you have receivables, then you can sell the, you can buy the put option. If you have payables, you can buy the call option. So options give you rights, not obligation. So here, if you have payables, so you need to buy that currency, so you can buy a call option. If you have receivables, you want to sell that currency, so you can buy the put option. So this will give you right, no obligation. This will be useful when you don't know which direction the movement of the price of the currency would go. So money market hedge is arbitrage based. You borrow in one currency and invest in another currency, and indirectly you create a synthetic forward rate. So when the covered interest parity or the interest rate parity holds good, the forward will give you exactly same results as money market hedge. They give you the same outcome. So here you are creating the forward yourself. So when derivatives are not available, then you can use the money market hedge. Right? Thank you from my side. Any questions, please ask. I'll take up those doubts or problems. I'll quickly sum up then what we have covered today.
Ma'am, can you please share the slide one so that we can take this screenshot?
Sure. Right?
Thank you, ma'am.
Welcome. Apart from this, I'll just quickly recap whatever we have done today. So we started with the role of derivatives and options in case of foreign currency hedging. So in forward, a rate is fixed, you use that. In money market hedge, here, like we said, US firm requires pounds. So you have pounds payable in foreign currency. When you have pounds payable, so you deposit in foreign currency and borrow in your home currency. So for receiving exactly 300,000 pounds, you will invest in UK at 4.5%. by borrowing in US at 5.5%. Here again, as per ICAI calculation, so 4.5 is the interest rate for 180 days. In call option, the important thing is the prices can be given. Various exchange rates can have different probabilities. So to find out what is the expected price, you find the expected value by simply multiplying, or if you remember the quantitative aptitude in your CPTs, summation xi pi. This is the expected value. So what will be the expected spot rate after 3 months or 180 days? 1.91 into 0.25, 1.95 into 0.60, and 2.05 into 1.15. So if you don't use hedging, this will be applicable. However, if you use hedging, like call option, then it is 1.91 plus 0.04, 1.95 plus 0.04. Here you will not use 2.05, you will use the exercise price. 1.97 plus 0.04. Okay. So this is your exchange rate 1.9830. Another important thing here is you have to pay the premium upfront. So you may take an opportunity cost of interest on that upfront premium. Now, no rate of interest is given here, but you can see that you are a US firm. So you can apply the amount that you have to pay as premium, and you can apply the 5.5% borrowing rate as the interest opportunity cost, or 5% as the deposit rate. Okay. So if you actually borrow and then invest in initial premium, you will use 5.5. But if you use your own funds to pay the premium, you can use the opportunity cost of deposit rate 5%. They will give you a little different answer, slightly different. Okay. Right. So 300,000 into 0.04, your initial premium would be $12,000. So you can also take a cost of interest on $12,000 at 5% as opportunity cost. Okay, so 1.9830 into 300,000 plus interest on opportunity cost. So if you don't go unhedged, you pay 1.955. If you use forward contracts, you pay 1.96. If you use money market hedge, then you deposit in UK and borrow from US. So you end up paying a fixed amount. If you use options, then it is 594,900. Plus, if you will take the interest cost of 5% for 180 days on 12,000, maybe you get the answer as 595,560. Expected spot rate that we have already calculated. This is how money market hedge works. Investment alternatives. So convert your US dollars into pound for London and euro for Frankfurt. And in US, it will remain as it is. Pay the $505,000 in London by converting it into pounds. Here also, you will convert it into pounds. And whatever the inflow you have, again convert it into pounds here in New York and in Frankfurt. So this will give you, these are the rates given. Remember, be careful that the swap rates for London on Frankfurt are at decreasing. So you have to subtract to calculate the forward rates. So what is the pound return on investment made in US, in London? So 500,000 USD converted into pounds and then invested in pounds. Together with interest, then become this much. And the 505,000 converted into pounds to pay. So you have to buy dollars or sell pounds. So when you are selling pounds, bid rate is applicable 1.5430. Same here. Then early delivery, I'm sure clear that you can make the investment, ask the bank to take the early delivery. If the bank takes early delivery, there can be swap loss to the bank, because whatever you gave, bank will have to sell at 85.22 and cover itself in the forward market at 85.42. So bank sells at 85.22 and buys at 85.42. This is the swap loss. And interest, because bank is going to sell at 85.22 but to pay you 85.40. So 18 paisa on 100,000. 18,000 interest will be calculated at 18%. There is another option. You don't go to the bank on 30th November, but invest 100,000 in US at 3%. So in that case, you end up having extra money. This extra money you will sell at the forward rate on 31st December. 1 lakh, you will get 85.40, and for the interest, you can sell it at 8.532. Okay. Right. Then this was one question where you have imports and exports. Exports is after 3 months and imports are after 6 months. So for exports, bid rate 87.10101, this will be applicable. Convert it into invoice into dollar, into euro, into pound using these rates, and then convert it again into rupee using the forward rate with using these interest. For imports, use the ask rates to find out the invoice value in dollar, euro, pound, and use the same rates to calculate the forward rates for converting into rupee again. Right? And then we had taken a few questions on international financial management, home currency, foreign currency, risk premium,
Ma'am,
and how
in
we.
this question, I had a query.
Yes.
This actually, I just wanted to ask, while in the international market, why will we are going to discount the per annum what cash inflow with the square rates? मतलब rates, why we are compounding the rates?
We are compounding the rates because if you remember the capital budgeting chapter, so it's like 0 year, the present value of this is divided by 1. And if it is first year, year 1 cash flows, you divide it to find out the present value, divide by, let's say the rate of interest is 10%. So you divide by 1.1. Then cash flow of year 2. So that means 1.1 square. So on.
अच्छा वो that concept है.
Amount is equal to principal 1 plus I raised to the power n. So to find out the present value, which is the principal, amount divided by 1 plus I or discount rate raised to the power n. So after 1 year, I am discounting by 1. After 2 years, square. After 3 years, 3. After 4 years, 4. After 5 years, 5. If these are same, we use PVIFA. Okay, we add all these and multiply. Had this all been 20 lakhs, we would have used that. Okay.
Okay, ma'am. Thank you.
So anything else, team? Any other question? You can paste your questions on the ICAI portal. Okay. Just have a look. I'll share this PPT with you. Have a look at it. If you have any other question, you may ask me.
Thank you, ma'am.
Thank you. Team, you can post your queries at SFM, or let me write it, SFM final at ICAI.in, or you can call at 0120 3045 956. Okay, right?
Sure, ma'am.
Anything else? I hope the revisionary sessions were of help to you.
Yes,
Yes.
definitely.
Thank you. All the best. Do your very best. Read the questions very carefully and then attempt them, right? Anything
Only
else
this
I can
hedging and
help with?
derivatives are very much complex. Rest of the questions are like we can easily do it, but this
Come again, please. Sorry.
Derivatives and hedging means this money market and hedging is creating a little bit more problem.
I'll
Of
try to revise for you. Money market is simple. See what is happening. Think about it that I am going to receive $50,000. Okay. I'm going to receive $50,000. Is that clear?
Yes, ma'am.
But after 5 months or after 6 months. So what is my problem? My problem is today the dollar is of 90. What if after 6 months dollar becomes 30? Or I'll keep it simple, 100,000. So whereas I was supposed to be receiving 90 lakhs, I end up receiving how much? Only 30 lakhs. Huge loss. Okay?
Yes.
So if I can do something that this is me, and if I receive the dollars here and they go out, whatever I receive is also my payables. I paid. So even if it is 90, it doesn't matter me. Even if it is 30, it doesn't matter me. Even if it is 1, it doesn't impact me. And even if it is 100,000, it doesn't impact me. Right? What is happening? They are simply passing through me, no? Absolutely no impact on me. Right?
Mm.
But how will I create a payable? If I want to pay someone, I should borrow from someone today then. How will I create a payable? So to create a payable, like I said, if it's a money market hedge and if you have receivables or asset, you borrow in foreign currency, right? So
Okay.
you borrow $100,000, borrow them, but not $100,000. So what is the US rate of interest for deposit? Let's say 2%, for borrowing 3%. So why should I borrow 100,000? 100,000 is I have to pay with interest. So today I will borrow the present value of 100,000. Okay? Got
Okay.
it? So 100,000 divided by 1.03. I will borrow only $97,087. Now I can convert it into rupee at the current spot rate. Okay?
Yes, okay.
Today the spot rate is 90. So I get 87 lakh something, which I invest in India. So if this is what I invest in India, I'll end up getting this into 1.1. So my inflow in rupee is fixed, no matter where the dollar moves. Got it?
Okay, ma'am. Okay.
So you tell me, if you had payables, what do you want to do? You have payables here, right? So you create receivable. This is what you create. Okay. Now to create receivable, why will someone give you after 6 months when you lend it to him today or deposit? So if you deposited somewhere or you have given loan to someone, that person will give you, repay you. So you will receive from him and make the payment of your dollars. So create receivables. So when you create receivable, you have to deposit. So then I would have deposited the present value of 100,000 by 2% and then converted into, but where will I get that money from? So that I will arrange from the Indian market at 90. I'll borrow this much in the Indian market and repay together with interest at 12%. So if you have payables, this is what is applicable to you. And if you have receivables, this is applicable. Okay.
Okay, ma'am.
All right. So we can call it a day.
Ma'am,
Yes.
ma'am, in futures contract, when hedging through futures, but future contract is given in opposite currency, can you explain that point, ma'am?
So if I had dollar receivables, I am fearing that the price of dollar may not go down from 90 to 30. My fear is this.
Yes, ma'am.
So I will sell something, sell dollar futures, which may be trading at 90 or 89 something, right? So if the price is likely to go down, that means it is high today. So if something which is high today, you will want to sell it, sell dollar futures. But what if the dollar futures are not available? Rupee futures are available? Opposite. Then buy rupee futures. Okay. So if dollar futures were 100,000 and the contract size of $1 is also 100,000, so you would have bought $1 futures, you would have sold. But if it is 90 lakhs and rupee futures standard size is 2,30,000, then you will find out how many rupee futures you have to buy, round off. Okay.
Means first we have to convert the dollar into rupees using the spot rate, and we have to find the future contracts.
Future contracts, number of future contracts, and the standard size of the rupee future contract. Okay.
Okay, ma'am. Thank you.
Welcome. Anything else? All right, we can call it a day. All the best to all of you. And in case of any query, please refer to this. Thank you, Ashish. Thank you, everyone. Thank you, Ashish ji.
Yes, ma'am. Thank you very much.
Mhm.
Madam, today we have done with the foreign exchange exposure and risk management and international financial as well.
Right.
Okay, so I think student, with this we have come to the conclusion, finishing of the two important topics, that is chapter number 10 and chapter number 11, because both are related to foreign exchange. And first it was foreign exchange exposure and risk management, where the hedging technique was the main. And in the next part, that is chapter number 11, it was financial management in context of the foreign exchange. So with this, we can say that one of the very important topic has been over. So student, if you still have any doubt, so you can contact us as this number, or you can send us the email. So thank you, madam, for sparing your precious time and letting the student. And thank you, student, for patient listening. Thank you very much.
Thank you, sir. Thank you.
Thank you,
Thank
sir.
you, everyone. Bye.
Thank you. Thank
Thank you, everyone.
Thank you. Thank you.
you. Thank you.